And as we do each week, minus Keelan's money chat, we'll go ahead and start out with mine.
Money.
Tina Mitchell here with this week's Money Chat. Our good friend, author Kajan, shared some inside information on shipping with us from one of his contracts. He explained that many are seeing ships of containers delayed and they expect it to go through the end of the year, potentially causing some issues for the holidays as well. But this really speaks to more lasting inflation and not the transitory inflation that the feds have been speaking about. Powell's speech, he chose his words and his remarks very carefully and did not give too much information in his Q&A session. He stuck to the fact that he thinks that most of the inflation that we are seeing will be transitory and is tied to reopening and temporary issues. When pressed on the labor openings, he did admit to seeing an improvement once the extra unemployment benefits expired. Atlanta Fed President Raphael Bostic redefined for us in his thoughts on transitory, saying that it is going to be a little longer than expected initially. Rather than it being 2 to 3 months, it may be 6 to 9 months. St. Louis Fed President James Bullard spoke on CNBC and was very transparent on his views on inflation, on when the Fed should when the Fed should start hiking interest rate. He believes that the Fed was surprised with how much inflation had seen and thinks that there is upside risk to their inflation forecast. Part of the reasoning is that there will be more inflation when certain states get back to business as usual and when other countries around the world reopen and see a boom like we have here. This could lead to importing inflations. Currently, the Fed's median forecast shows that core PCE inflation averaging 3% in 2021, with it dropping to 2% in 2022. This would support their feelings that inflation is transient. But Bullard thinks that there will be a spillover in inflation in 2022 and thinks that the PCE will average 2.5% in 2020 and won't fall back to 2% until 2023. Because of this, he unveiled that his dot on the anonymous dot chart, which shows that the Fed members think about the Feds when they should actually hike, said in 2022. On tapering, he said that he believes that the Fed needs to be nimble and be ready to make adjustments as necessary. He also expressed that he feels that the Fed does not need to be involved in mortgage-backed securities with a booming housing market and potentially threatening to the housing bubble. These are just his thoughts, but it would support that the Fed is going to cut mortgage-backed security purchases first ahead of treasuries. The Fed's balance sheet has pierced $8 trillion for the very first time. For some perspective on this, stacking $8 trillion worth of $100 bills on top of each other would span 5,429 miles more than the distance from New York to California and back. With almost no inventory, Zillow reported on the single-family rents were up 2.3% in May alone. CoreLogic said that the rents rose 5.3% year over year, which is the largest gain in nearly 15 years. We have been saying that rents would eventually go up. Now, rents for single-family detached homes, not condos, were up even stronger at 7.9% compared to a year ago, likely because individuals are seeing more outdoor space or wanting to live in more outdoor space. Nearly half of the millennials and surveyed by CoreLogic and 64% of baby boomers said that they strongly prefer to live in a single stand-alone home. June's consumer sentiment survey came out showing that consumers' plan to buy a home has been steadily decreasing from 127 in March to 74 in June. The media has been having a field day with this stat, saying that it points to potential for trouble in the housing market. Now, it's important to note these are only plans to purchase, and those plans could change. Many were probably feeling good after receiving many stimulus checks in March, and when they finally got out to the market to purchase a home, felt a little bit discouraged with the lack of inventory and the higher prices. We see the same story playing out in cars. The index was 118 in April, down from 89 in June. Again, buyers likely had big plans those after receiving the stimulus, and those plans changed in the recent reading. Now, both of these levels are at the lowest since 1982. Now, LendingTree came out with a report showing that median housing costs were higher from homeowners than renters in all 50 of the largest US metros. But for how long? Rental prices are a lagging indicator and are going to continue to go up. You're not going to rent your home for the same amount previously if your home was priced has appreciated at 13% or more, but you may be contractual bounded for a period of time. Now, when this goes up, it will cause inflation to move higher, as well as it will be a big part of the CPI and the PCE. Now, there's a lot of concerns being voiced in the media regarding forbearance and how this may have a surge of inventory that could cause a problem for the housing market. This is not a concern. Forbearance is similar to hitting a pause button on your mortgage payments. When the borrowers exits their forbearance, that pause amount gets added to their loan with no interest. This amount is paid off when they sell or refinance. Now, 87% of loans are below an 80% loan to value, which provides homeowners with a nice position of equity, which will be a cushion for them. Initial job claims, which measures individuals filing for unemployment benefits for the first time, fell by 7,000 to 411,000, still at a much higher level than we'd like to see in this period of time. Continued claims, or those that continue to receive benefits, fell 144,000 to 3.4 million, which is a pandemic low, but also still elevated. Now, the pandemic unemployment assistance claims, which gives individual benefits who would not usually qualify, and the pandemic emergency claims, which extends benefits after regular benefits expired, increased by 68,000 combined. Some are saying that we are not seeing a drop in the claims as expected after many states cut their additional benefits. It's too early to tell, and this will definitely take some time. Also, remember that this is only state portion, and they do still receive the federal additional benefit. We'll not likely see a meaningful improvement until after Labor Day, when those benefits removed. New home sales, which measures signed contracts on new homes, were down 6% in May, but this figure is actually worse when you factor in the revisions, totaling a 12% decline. Looking at the inventory levels, there were only 330,000 new homes for sale. Total inventory showing 1.23 million homes for sale, which is up 7% from April, but down almost 21% year over year. At least it appears that we are seeing some movement in the right direction. Homes were only on the market for 17 days on an average. Now, the national median home price was reported at a record high, $350,300, which is up a record of 24% year over year. The media has had a field day with this, quoting that people are getting priced out of the city and we have affordability issues coming up. We know that the median price is just the middle price, and it is driven by predominantly due to the mix of sales. Sales between 500,000 and 750,000 were up 122%, 750 to 1 million up 178%, and 1 million plus 245%. Meanwhile, sales on the lower end beneath 250,000 were lower. Real appreciation is around 13% and still hotter than we would like to see for sustainability, but well beneath the 24% median home price. And speaking of affordability, first-time home buyers have remained at 31% for 3 out of the last 4 months. So I think the lack of sales is due to the inventory, not to the affordability. Cash buyers decreased from 25% to 23%. Investors purchased 17% of homes, which remain stable. The Mortgage Bankers Association released their mortgage application data showing that purchases rose 0.6% last week and are down 14% year over year. Refinances were down 5% last week and are down 27% year over year. The refinance share of mortgage activity increased to 60.4% of all transactions to 61.7%. And on interest rates, their 12 basis points are roughly 1/8% lower than this time last year. Tina Mitchell here, and that was your Money Chat.